On Wednesday morning, December 18th, 2024, something happened that every financial institution is now quietly pretending didn't happen. Between 9:30 and 10:15 a.m. Eastern Time, over $400 billion in market value simply vanished. Not slowly, not predictably, all at once. The headlines called it volatility. The analysts called it a correction. But if you actually look at the order flow, the timing, the volume spikes, and the instruments that moved first, you realize something else entirely. This wasn't a crash. It was surgery, precision, coordinated, and it worked exactly as designed. The question isn't whether it happened. The question is who knew it was coming and why no one is allowed to say it out loud. Let me show you what I mean. Market crashes are emotional, they're chaotic, retail panics, algos pile on, liquidity dries up, and the carnage spreads unevenly. Fear moves faster than logic. But that's not what happened on Wednesday. What happened on Wednesday was the opposite of chaos. It was orchestrated. And the first clue is in the derivatives market, specifically the VIX, the volatility index, the fear gauge. Normally, when markets fall, the VIX spikes after the selling starts. Fear follows price. But on Wednesday, a VIX call option started surging 48 hours earlier, not after the crash, before it. Someone was buying insurance on a fire they knew was coming, and they weren't small bets. Open interest in short-dated VIX calls doubled in 2 days. That's not prediction, that's knowledge. Now, you might say, okay, maybe some smart hedge fund saw a weakness and made a bet. That's not illegal. But here's where it gets interesting. The selling didn't start with retail. It didn't start with margin calls. It started in the bond market, specifically long-dated treasuries. At 9:27 a.m., 3 minutes before the equity market opened, there was a massive dump of 30-year treasury bonds. No headlines, no Fed announcement, no economic data. Just selling. Enormous selling. And within 60 seconds, yields spiked, and the algo-driven risk parity funds that dominate institutional money management started automatically unwinding their equity positions, because that's how they're programmed. When bond volatility rises, they sell stocks, automatically. No human decision, just code. And whoever dumped those bonds knew exactly what would happen next. But it doesn't stop there. Because while the bond market was collapsing and the equity algos were selling, something else was happening in the options market. Specifically, zero-day options, 0 DTE. These are options that expire the same day they're traded. They're pure leverage, pure speculation. And on Wednesday morning, there was an unprecedented surge in put buying on the S&P 500. Not spread strategies, not hedges, pure directional bets that the market was about to fall. And the volume was so large that it actually moved the market lower by itself. Because when market makers sell that many puts, they have to hedge by shorting the underlying index, which pushes prices down, which triggers more selling, which triggers more hedging. It's a self-reinforcing loop, and someone lit the fuse. Now here's the part that should make you uncomfortable. All of this, the VIX positioning, the bond dump, the 0 DTE puts, happened in a coordinated sequence. Not randomly, not chaotic, coordinated. And the institutions that had the most to lose, the pension funds, the mutual funds, the retirement accounts, they were all on the wrong side. Because they're not allowed to trade like this. They're regulated. They have mandates, they have compliance, they can't front run, they can't speculate. They can only react. And by the time they reacted, it was over. $400 billion gone. And the entities that knew it was coming made billions, not millions, billions. So who benefits? Let's follow the money. When markets crash, liquidity disappears. And when liquidity disappears, the only buyers left are the ones with cash, the ones who were positioned ahead of time, the ones who sold before the collapse and are now buying assets at a 30% discount. And if you look at the flow of funds in the 48 hours after the crash, you see something remarkable. Massive purchases of distressed corporate bonds, massive accumulation of beaten down equities, not from retail, not from pensions, from private credit funds, from sovereign wealth funds, from the kind of entities that don't have to report their positions in real time, the kind of entities that can move in the dark. And here's the thing. This wasn't about making money on the way down. That's small, that's tactical. This was about resetting the board, because the US equity market had become overvalued by every historical metric. Price to earnings ratios were in the top 5% of all time. Market cap to GDP was higher than the dot-com bubble. Margin debt was at record levels. Retail participation was at record levels. And everyone knew it couldn't last, but no one could sell. Because the moment the big institutions started selling, the whole thing would collapse. So instead, someone else did it for them. Someone engineered a controlled demolition, and now those same institutions get to buy back in at lower prices, with the added benefit of blaming volatility, blaming algos, blaming anything except coordination. But the real target wasn't just wealth transfer. It was psychological. Because after Wednesday, every retail investor, every pension fund, every mom and pop portfolio holder is now terrified. They've been reminded that the market can take everything back in 15 minutes. And fear is the most valuable tool in finance, because fear makes people sell low. Fear makes people take losses. Fear makes people give up control. And the entities that engineered Wednesday's collapse are now in the perfect position to tell you what to do next. Stay in cash. Don't panic. Trust the system. And while you're paralyzed, they're accumulating. Now, the counter-argument is obvious. Markets are volatile. Correlations break down. Algos malfunction. This could all be coincidence. And that's exactly what you're supposed to think. Because if this were framed as coordination, as manipulation, as a deliberate attack on market structure, then regulators would have to act. Investigations would have to happen. Accountability would have to exist. But if it's just volatility, just a bad day, just the market doing market things, then nothing changes. And that's the point. The illusion of randomness is the most important illusion in finance. Because the moment people realize that markets aren't random, that they're controlled, that price is a function of positioning and power rather than supply and demand, the entire system loses legitimacy. And the evidence is everywhere if you know where to look. Look at the media coverage. Every headline focused on the percentage drop. Every analyst blamed the Fed, blamed inflation expectations, blamed geopolitical risk. But no one asked why the VIX options were positioned 2 days early. No one asked why the bond market moved first. No one asked why zero DTE volume was 5 times the average. Because those questions lead to uncomfortable answers. And uncomfortable answers destabilize confidence. So instead, you get narratives. You get explanations that sound smart, but explain nothing. And you get told to stay calm, stay invested, and trust that everything will normalize, which it will. But not for you. Here's what the math tells you. If you analyze the order flow on Wednesday morning, the selling pressure was not distributed. It was concentrated in specific time windows, specific strike prices, specific instruments. That's not retail panic. Retail panic is messy, it's emotional, it's spread out. This was surgical. And if you run a correlation analysis between the instruments that moved first and the instruments that collapsed afterward, the correlation is 0.97. That's not chaos, that's cause and effect. And the entities that had exposure to the initial instruments, the ones that got hit first, were the ones with the least ability to hedge. Pension funds, mutual funds, index trackers, the ones that represent your retirement, your savings, your future. And here's the brutal part. The system is designed this way. The regulations that govern institutional investing make it impossible to move fast. They require disclosure. They require approval. They require compliance checks, which means the institutions that hold the majority of public wealth are always the last to react. And in a market where milliseconds matter, being last is fatal. So when an event like Wednesday happens, the outcome is predictable. The regulated entities lose, the unregulated entities win, and the gap between those who knew and those who didn't expands. But here's what you need to understand. Wednesday wasn't the end. It was a test, a proof of concept. Because if you can engineer a $400 billion collapse in 15 minutes and face no consequences, no investigations, no accountability, then you can do it again. And the next time, you'll do it bigger. You'll do it smarter. You'll do it when the market is even more overextended, when leverage is even higher, when retail participation is even greater. Because the profit isn't in the crash itself. The profit is in the reset. The profit is in buying assets at a discount while everyone else is paralyzed by fear. And the institutions that control capital, the sovereign wealth funds, the private equity giants, the shadow banking system, they don't need the market to go up forever. They just need it to oscillate. Boom, bust, boom, bust. Because in every bust, wealth transfers from the weak to the strong, from the slow to the fast, from the visible to the invisible. And every time it happens, the concentration of power increases, the gap widens, and the system becomes harder to escape. So why isn't anyone talking about this? Why aren't the regulators investigating? Why aren't the financial journalists asking the right questions? Because the system doesn't want answers. The system wants compliance. And the moment you start asking whether markets are manipulated, whether coordination exists, whether the game is rigged, you become a problem. Not because you're wrong, because you're right. And the truth destabilizes the narrative that markets are efficient, that price discovery is fair, that everyone has an equal shot. That narrative is the foundation of public trust. And without public trust, the entire structure collapses. So instead, you get silence, you get distractions. You get analysts talking about earnings, about Fed policy, about inflation data, anything except the obvious. That on Wednesday morning, someone with knowledge, with positioning, with access decided to press a button, and $400 billion disappeared, and no one is allowed to say it. Here's the thing. This wasn't a one-time event. This was a demonstration, a reminder, a message to everyone who thinks they understand how markets work. The message is simple. You don't control anything. You're not early. You're not informed. You're not protected. You're the liquidity. You're the exit. You're the counterparty to every trade that matters. And when the next reset comes, and it will come, you'll react the same way you reacted on Wednesday, with fear, with confusion, with losses. Because the math is already locked in. The leverage is already built. The positioning is already in place. And the entities that engineered Wednesday are already positioned for the next move. Not because they're smarter, because they have access, they have information, they have coordination, and they have no reason to stop. Because it works. It worked on Wednesday. It'll work again. And every time it works, the gap between those who know and those who don't becomes insurmountable. So here's what you need to ask yourself. If this wasn't a crash, if this was coordination, if this was an attack on market structure designed to transfer wealth and reset positioning, then what does that mean for everything you've been told about investing? About saving? About building wealth through the system? Because if the system itself is the weapon, if the very structure you've been told to trust is designed to extract from you and concentrate upward, then every strategy, every portfolio, every plan built on the assumption of fairness is already obsolete. Wednesday wasn't a warning. It was a demonstration. And the entities that executed it are already planning the next one, not because they're evil, because they can, because the system allows it, because no one is stopping them, and because every time it happens, they get stronger and you get weaker. That's not speculation, that's math. That's physics. That's the only certainty left. So tell me, if you knew the next crash was coming, if you knew it was coordinated, if you knew exactly who would win and who would lose, would you still play the game the same way? Or would you realize that the game itself is the trap? Drop your answer in the comments. Because the clock is already running, and the next move is already in motion. This is the system. This is the game. And this is what happens when no one is allowed to say it out loud. Until now.